Hey guys, it's Aman
and Christina
from Our Rich Journey. Today we are talking about the impending index fund bubble that you will hear people talk about. Now, Christina and I, we are index fund millionaires. We have built our wealth by investing in low-cost index funds that track the total stock market or sectors of the stock market. But if you are going to be investing in index funds, there is an argument that you are going to hear time and time again from a certain group of people. And it is that by investing in index funds, you are actually investing in an index fund bubble. But before we go any further, let's first define exactly what an index fund is. Now, an index fund is actually a type of mutual fund, but this type of mutual fund tracks a group of stocks that are on an indice. So when you buy an index fund that, let's say, tracks the S&P 500, that means that by investing in that index fund, you actually own a part of all of the companies that are on that index. This is why index fund investing is so amazing, because with a little bit of money, you can invest in a whole lot of stocks.
So if you want to learn more about the specifics of index fund investing, we have a video on our channel. We will leave a link to that in the description below. But for now, let's focus on why some people think that we are in an index fund bubble. There are 5 main reasons, and we'll start with the first reason, which is rapid growth. So there has been an exponential growth of index funds over the past couple of decades, leading some people to believe that the market is overheating. The next reason for the bubble is blind investing. Now, this is a belief that investors are blindly throwing their money into index funds without really realizing the importance of risk and evaluation of individual companies. The third reason is market concentration. Now, when people talk about market concentration, index funds, and the bubble, the idea is really that this market concentration is going to lead to decreased competition among companies. The next reason is herd mentality. And there's this idea that index fund investing encourages this type of herd mentality, which could exacerbate stock market crashes. And finally, there's synchronized trading, where there's this idea that index funds trade in sync, which could cause further market disruptions.
Now, all 5 of these arguments are typically what cause a bubble. I mean, think about it. Rapid growth, blind investing, people just doing things because everyone else is doing them. Typically, this would be the cause of any bubble. But index funds are a little different. So let's debunk each and every one of these arguments. So to the first argument about rapid growth, that index funds are growing too fast and maybe this is unsustainable. Well, the fact is, index funds are a relatively new investment, and it wasn't until recently that investors recognized the value of investing passively in the stock market. And so investors are more savvy than ever before, and they are making educated investments in index funds. So the growth is in response to educated investors being able to invest themselves rather than handing their money off to a mutual fund manager. And another thing to remember is that even with the rapid growth, index funds still only make up a fraction of the overall financial market. And so the rapid growth of index fund investing is really a shift in investor preference and not a sign of an impending crash.
So let's address blind investing, this concept that people that invest in index funds aren't doing the research into the risks or different evaluations of individual companies. Now, a lot of people like to think that that is how you are supposed to grow your portfolio. You need to be very active with your research and identifying the specific investments or individual companies that you can put into your portfolio to help your money grow. But studies have actually shown that by putting your money into an index fund that is diversified across the market, these types of investments can actually outperform people that are picking individual stocks, despite the fact that people that are picking these individual stocks typically spend so much more time researching their investments than someone that's investing in an index fund.
The fact that you can sit back passively and put your money in the overall stock market and do better than someone that is doing research every single day, this is the amazing part about passive investing when it comes to investing in index funds. Now, the next argument to address is market concentration. With this particular concept, the idea is that when you invest in an index fund, you are concentrating your investment in the largest companies that make up the greatest portion of that index fund. And because your money is going to the biggest companies by default, it means that those big companies don't have to compete for your dollars because they're already in the index fund. Well, this is not the case, because in order to stay at the top of these index funds, you still have to compete as a company to stay at the top. Analysts, individual investors, everyone will be looking at your company, and if you are not performing well, you will move down the totem pole. And so the concentration at the top, that is always shifting. I mean, look at any index fund over the past 10 years. The companies that were at the top 10 years ago are not the same companies that are at the top today.
So let's talk about the next concern, which is this herd mentality. This idea that if so many people are investing in index funds, what happens if all of these people pull out at the same time? This could cause a market crash. Well, the concept of herd mentality when it comes to investing is not as applicable to index fund investing as it is to something like an individual stock. So I'll give you an example. Let's say that there's an individual stock and the company does very poorly and that stock price begins to drop rapidly. That's where you're going to see a lot of people trying to get out of that investment. They're trying to sell their shares, and this is causing the stock price to drop more and more. But you don't see that same type of herd mentality with index funds. So for example, when there is a crash in the total stock market, you don't see all of these same types of people rushing and trying to sell their index fund that's invested in the total stock market. In fact, you're going to see people staying the course and even buying more index funds during a crash.
You see, the index fund investor is the type of investor that has patience. They are not trying to time the market. They are just trying to slow and steadily build wealth. So to the last point of the index fund bubble argument is that index funds trade in sync. And because they trade in sync, they have the potential to cause a market disruption that could lead to a collapse or a bubble. Well, you see, first of all, there is a huge fallacy when it comes to this argument because index funds don't make up a large enough portion of the overall trading activity on the stock market to represent a serious danger to the stock market. You see, the majority of trades that take place every single day are done by active investors, actively managed mutual funds, individual investors, hedge funds, not index fund investors. Index fund investing has some of the lowest turnover on the stock market, and so it doesn't represent the potential danger of a typical bubble investment. So now that we've addressed all of these arguments for the index fund bubble, let's talk about where these arguments are coming from. Who are the people that are saying there's an index fund bubble? Well, it's the financial industry that is saying this. It is the people that want you to give them your money so they can invest it for you and charge you a fee. You see, when you invest in index funds, you are investing in a low-cost passive investment. And because it is low cost and passive, it means that you are paying the financial industry less money. And that is something that they hate to see. And so they are incentivized to tell you that you are investing in something that could potentially crash. But in reality, passive investing is some of the safest investing in the stock market.
Now, of course, these are just all our own personal thoughts about investing in index funds. Like we said, investing in index funds allowed us to reach financial independence, it allowed us to grow our wealth, and even allowed us to retire. Index fund investing has really opened up investing to a lot of new investors. People that weren't able to previously invest in the stock market are now able to do that through index funds. So if you want to learn more about all of the benefits of index fund investing, definitely check out the other videos on our channel. We have so many videos on index fund investing. And if you want to learn more about investing in the stock market, we actually have a stock market investing course that helps you develop your own unique stock market investing plan. We will leave a link for that course in the description below, or you can also go to ourrichjourney.com to learn more. Now, if you like this video, do us a favor and give us a thumbs thumbs up, subscribe to our channel, and join the journey.